Thank you so much for that wonderful introduction. I want to make clear first that the views expressed here are my own and my co-authors. They do not necessarily reflect the views of the Fed. All right, so we know there are a lot of anomalies. You might not have seen the anomalies in this form before. This is the Anomaly Zoo in one chart. So if you can see the text, my apologies, the text is a bit small. You can take your time and look at the paper later. There's TVs on the side in case you're closer to them. At the very top, it says A-turn. That stands for asset turnover. And then moving down to the x-axis, it says that if you trade on asset turnover, you get a gross return of about 50 basis points per month in sample. And if you explore this chart, you might see your favorite anomaly, hopefully. There's been, value is not doing that well recently, but it's represented by BM that sits between 80 and 100 basis points. And momentum has this outstanding return of between 120 and 140 basis points in sample. Okay, so this is a zoo of anomalies, right? There's so many anomalies with these huge returns. And it begs all sorts of questions like, what kind of factor model, what kind of model of risk can explain this zoo? And once you found your 14-factor model that can explain this zoo, can you rationalize your 14 factors in a way that actually makes sense in terms of risk? Which of these anomalies are redundant? Do we actually need all of these anomalies? Can they kind of be thought of as together? And on the converse, are there synergies between anomalies? Can some of these together become even more powerful than they are on their own? Or you might ask kind of a question that weighs heavily apparently on everyone's minds when you see so many anomalies that are discovered. What share of these returns, of these huge returns of more than 80 basis points every month, what share of that is due to data mining? Now, in this paper, I'm sorry about this, but we're not gonna address any of these questions, okay? But I promise you, we're gonna address a fascinating question. Because our question, in our view, is fundamental. In our view, you have to answer this question before you should even consider all those other very also interesting questions. And our question is just this: how much profit should investors expect means in the future, right? Expect in the future from investing in anomalies. In other words, we just want to know the expected return before any fancy risk adjustment. Now, why is it that I think that the existing literature doesn't answer this question? Why don't we already know this answer? I think there's two reasons why we don't know the answer to this question. One is because the standard approach to documenting anomalies is to average over decades of history. Of course, we need to do that to make sharp inference with the noisy stock returns, but that leads to a problem, right? If we have so many anomalies, we have some data mining bias going on, and also investor learning will happen after publication. That means that you can't expect those returns we saw on that previous slide to persist into the future. Those returns from the 1970s, you can't expect those to occur in the year 2020, and this is beautifully demonstrated by McLean and Pontiff. The other reason is much simpler. The anomalies literature measures gross returns before trading costs, and gross returns are not profits. So therefore, we have not gotten at expected profits. We have not gotten at expected returns. Okay, this is a very difficult question, admittedly. Okay, so I'm not going to be able to answer the question for everyone, everywhere, at every time. But we'll take a large step forward. Okay, and so what we'll do explicitly is we'll study the post-publication return, so we'll remove investor learning, we'll remove data mining bias, and we'll study 120 anomalies. And our costs, we'll measure costs in a pretty strict way. We'll measure costs using effective bid-ask spreads from high-frequency data. So that's the only cost we consider. We're going to omit price impact. I'm sorry, we have nothing to say about price impact. We have nothing to say about shorting cost. So you can think of our cost as a kind of lower bound. Like I said, we're not going to answer this question for everyone everywhere, but we're going to take, I believe, a big step forward by setting a kind of lower bound. And you'll see that even our lower bound has significant effects. Okay, so let me walk through the results kind of in steps, the summary of results in steps. First, if you take a look at the in-sample gross return, if you just average over all those anomalies in that first chart, you get 66 basis points per month, or about 8% per year. But that's in that old data. Of course, you can't expect that old data to work after these things are known to everyone. And so McLean and Pontiff shows that the returns drop by about half. but you still get about 4% per year market neutral. That's nothing to ignore. But that ignores trading costs. So the next bar is where our paper comes in. Once you account for trading costs, you get minus 3 basis points per month. Now, as alluded to in the previous presentation, academic strategies are not the most sophisticated. At least that's certainly not with respect to transaction costs. So we try to improve on that by adding some cost mitigation. This optimization might be a bit of a stretch, but we do optimize in a limited sense our cost mitigations. And after that, we get about 8 basis points per month. And this is ignoring shorting costs and price impact. So I would say, concluding from these results, or this preview, that the average investor should expect tiny profits from the average anomaly. Okay, so this is a very long literature on the trading costs of anomalies. It goes back to Stoll and Whaley in 1983, and of course, Ball, Kothari, and Schenck in 1995, and many, many papers following on them. Where our paper adds, in the simplest sense, is we have by far the most comprehensive set of anomalies being studied for trading costs at 120. And this is not just a kind of like a measurement of who has the bigger data set, but this is the only way you can make inference on post-publication results, on results without investor learning effects. And that's going to get us closer to expected profits. Let me try to head off some complaints here, explain what we do not study, okay? So we're not gonna study implementation shortfall. That is a very fascinating issue. I would like you to refer to Frazzini et al. And Briere et al. For those studies. We're not gonna study price impact. We're not gonna study combining multiple anomalies, which is also fascinating. And the reason why is because our question is so simple after all. We just want a benchmark expected return that we can kind of start from and build off of, right? We wanted some kind of benchmark before we get to what AQR's trading cost is or what some particular other investors' trading costs are. That's the only way you can get at implementation shortfall is you really need to complicate the question. We like to set a baseline before these to build off of for those other investigations. And in our view, these effective bid-ask spreads for single strategies forms this benchmark. This is, as I mentioned, the lower bound cost for an average trader, irrespective of the portfolio size. These single strategies are much easier to begin with before we start combining anomalies in optimal ways. To give a roadmap of what I'll do, we'll first discuss the ingredients, the anomalies data, and the trading cost measures. Then we go through the results in layers. Transaction costs are a complicated issue, so we'll just start with the published strategies before we add some cost mitigation to kind of get deeper. And then we're going to look at the selected cost mitigated strategies. Okay, so our anomalies data comes from a previous paper of mine with Tom Zimmerman that's now forthcoming in RAPS. There we replicated 156 cross-sectional stock return predictors. We removed 34 that are not continuous because in order to understand transaction costs, you need to understand mitigation, and our mitigations, our most effective mitigations, take advantage of continuity. And this is a kind of relatively minor issue, but of course we can't call the CAPM beta an anomaly, so we should remove that. And not sure whether to call a tail risk beta an anomaly or not, so we just removed that for safety. Okay, and also gets us a nice round number of 120 published anomalies. To give you a preview of what that looks like, 50% focus on CompuStat accounting variables, that's following on the Ball and Brown legacy. 30% use purely price data, that includes option market data. And 20%, 20% looks small, but that's still 24 anomalies, use a variety of data from analyst forecast to volume. How we measure trading cost is as follows. We track the portfolio weights over time. This is a very basic slide, so forgive me if you already know this. And whenever we enter or exit a position, we assume half the effective bid-ask spread is paid. Effective spreads use actual trade prices. So this is the formula for what they look like. It's a difference between the trade price and the quoted midpoint. And what this means is that when you enter your position, a long position, your trade price is above the midpoint, you've paid too much. And then when you try to exit it, your trade price is below the midpoint and you've earned too little. So when you take the round trip, you've earned too little compared to your profits are lower compared to the frictionless benchmark. Okay, so the interpretation, as I'd like to hammer home, is that every trader has a different transaction cost. I'd like to argue ours is a lower bound to an average trader. It's lower bound because we're omitting shorting costs, which we need to do to form long-short portfolios and price impact. So even the trading costs even the returns that we measure, the net returns we measure, are unattainable to many traders. And for the average trader, because we average across all trades in TAC, technically a small liquidity demander, and I just need to have the caveat that sophisticated arbitrageurs, they may and they will supply liquidity, but then they bear other costs, like adverse selection and execution risk, and the salaries of people like Kant and Kukanov. And as a reminder, our goal is a simple benchmark. Okay, the trading cost data is also a very large set of data. We're going to combine, for our post-publication results, which is basically the past 20 years, we're going to combine data from 3 different high-frequency data sets and use the best data whenever that's available. We're going to use in-sample returns in order to study the cost mitigation and try to make sure where our cost mitigation doesn't have any look-ahead bias. And so in the older sample, we need to use low-frequency data or daily crisp data to measure spreads. And for this, we average 4 low-frequency proxies. If you know the microstructure literature, they had developed a number of these proxies for spreads. We're going to average across them to try to remove noise. And I want to emphasize that high-frequency data is very important for our question. We want to know what happens after learning effects, after everyone knows about these anomalies. That means we need to look at the past 20 years, and in the past 20 years, there's a significant bias in these low-frequency spreads. If you use that kind of data, the bias is about 25 to 50 basis points, as you see in this figure. To give you a quick picture of what our data looks like over time, in the 1930s and 40s, you had huge spreads, and then they decline after the war. The spreads rise again in the 1970s as NASDAQ enters CRISP, and then finally they plummet very close to 0 in the recent sample. Okay, finally, we get to the good stuff, results. Okay, is the average published strategy profitable? We're going to take the strategies, quote, off the shelf. And by off the shelf is if you actually read these anomaly publications, like I've read way too many of these in my time, almost all of them focus on equal weighting, like almost all of them. They have certain incentives, right? McLean and Pontiff document this. We find this ourselves when we comb through the papers. And they use simple strategies. They just long short the extreme quantiles, and they rebalance when the signal updates, roughly speaking. So we do the same approach here, equal weighted long short quintiles. Quintiles is somewhat arbitrary, and we rebalance when the signal updates. This will give us a quick picture of returns. Of course, we want to study cost mitigation. Transaction costs are complicated, as I mentioned before. You can't really get at them until you get some mitigation, but here we get some simple results really fast. In fact, they're right on the next slide. So the average investor should expect no profit from the average published strategy. So you see this in the post-publication row. Let's focus on that row first. We start with 30 basis points per month of gross return, but then once you take out turnover and the spread, you get a -3 basis point per month net return. And I like to emphasize that the standard errors are small. We know something. It's hard to say much about any particular anomaly. You know, some anomalies were published in 2012. You're not going to be able to say much about that. But when you average across all of them, you could get standard errors that are quite small. We could say that there's not much to be had, at least using the published results, or published strategies, published recommendations. And it's also notable that net returns are negligible even in sample. And this table gives you a nice little decomposition of the decline in returns. So if you start with the gross return, you just have to subtract over the turnover times the spread, like the quantity times the price, and then you see that the math just works out. 30% turnover times a 111 basis point spread post-publication, that's just going to wipe out the gross return of 30 basis points. Now, this result may surprise you because, as we saw in that time series chart, the trading costs have plummeted after electronic trading and decimalization. Decimalization means the spread is, in terms of dollars, is 1 cent. With an average share price of $20, that means the spread's about 5 basis points, right? How can 5 basis points make a dent here? That's kind of surprising. The issue is that 5 basis points represents the mode, right? It represents the most frequently observed spread, and you see that in the data. This data is for 2014. This is recent data. So you have that huge spike at 5 basis points. That's the mode. That's decimalization. But notice the really, really long right tail. That scale is very impressive. That the first tick mark is at 50 basis points, an order of magnitude larger than the mode. You know, the tail goes even past 100 basis points. So the mean, if you average across all these spreads, is 67 basis points in 2014. And the published strategies, they really require you to trade across the entire distribution because we're equal weighting, right? But then that brings up the question, right? These strategies, we're wiping out, the published strategies don't work after publication. It wouldn't have worked if you just took them off the shelf, and I'm sure the people here know that you can't do that. So we want to ask, can a smarter strategy earn profits? So that brings us to some cost mitigation. So we're going to combine 2 techniques to mitigate costs. These 2 techniques attack the 2 dimensions of the problem. The 2 dimensions are the price and the quantity, the spreads you pay, and the turnover. We'll look at value weighting to reduce the spreads paid, and we'll apply a technique called the buy-hold spread. You may know of it as banding to reduce turnover. My co-author, Mikhail Velikov, together with Robert Novi-Marx in a couple papers, show that these 2 strategies together outperform several other cost mitigations. And as I promised, we're going to be free of data mining bias, free of look-ahead bias. So we're going to optimize these 2 techniques in sample, and then we'll re-examine the post-publication net returns. Okay, so let me explain how the buy-hold spread works in case you're unfamiliar with this. In one sentence, it mimics the optimal trading under transaction costs. If you heard of SS rules in economics, it's part of like this large family of optimal rules. It's very cool. But let me not get distracted by that. To explain how this works, let's start by diagramming out how long-short quintiles works. So this line here represents a whole cross-section of stocks, all stocks in one particular month, ranked from those with the weakest buy signal at the bottom to those with the strongest buy signal at the top. And long-short quintiles is super simple. In the extreme quantiles, you hold long, enter long. You go all out in the extremes. In the middle, you completely ignore. So it's a relatively stark strategy. So what the buy-hold spread does is it softens it a little bit. So in the extremes and in the very middle, you still have your kind of harsh position. But between the 70th and 80th percentile, you have a stock that looks pretty good, has a strong signal. So if you already hold it, then you want to hold on to it. On the other hand, the signal is not so strong that you want to incur a cost to get into that. And so the net result of this is that you can maintain exposure to your signal while reducing turnover. And as I mentioned, my co-author Mikhail Velikov shows that this is a very effective thing to do. I should go back quickly. The 70% cutoff here is arbitrary, right? We have to choose that somehow. So we choose that to maximize in-sample net returns, and at the anomaly level, we choose whether we value or equal weight. Some anomalies only work when you equal weight. And we'll see which ones those are. Here's the formal optimization problem. Let's not go there. The specification here just aims to balance performance and robustness. We don't want to overfit the data, but we still want to get something out of this. Okay, so these next 2 figures I'll show you the performance of this cost mitigation. It performs well, in sample at least. Once again, this is a long list of anomaly names, and notice that the mode, this is before cost mitigation, notice that the mode is at 0, and there's a fat left tail. And if you average across all of these net returns, you get 5 basis points per month. After cost mitigation, the whole distribution shifts to the right, and that left tail is much, much smaller. The whole scale has changed. Now we only go out to minus 60 basis points instead of minus 300. Averaging across the cost mitigated strategies, we get 38 basis points per month. This is a fun figure, not for, I don't want to make you squint. You should please refer to the paper. Here you can see exactly which anomalies you should evaluate, which ones you should apply a buy-hold spread to, and which ones it makes a big difference in. But as a reminder, this is the performance in sample. We can't expect this to persist because of learning effects and data mining bias. Okay, so what happens after publication? We get our second main result. Average investors should expect tiny profits from the average cost mitigated strategy. So I'll show this in an event time plot. This is a plot of the return in the months relative to publication. The axis is in years, but the data is actually monthly. The gray line shows the average return across those 120 anomalies in that given month relative to publication. So even after averaging across 120 anomalies, you still have a ton of noise. So we try to smooth out that noise using that blue line. That's a trailing 5-year average. And using that, you see that the sizable net return is about 38 basis points per month in the years just prior to publication. They plummet right around publication. And after publication, you get 4 to 13 basis points, depending on how you average. You can see that there's kind of a downward trend that kind of complicates things. So there's not much even after cost mitigation once you do it in a look-ahead bias-free manner. We have one more analysis for you, the best cost-mitigated strategies. One more pessimistic analysis, unfortunately. So to motivate this last analysis, notice that, so this is the distribution of net returns post-publication. And if you can see here, the highlighted blue text are size, book to market, and momentum. And notice these are the better performers. After trading costs, after publication, these guys still earn you profits. And that's consistent with recent papers that study implementation shortfall. Okay, so that brings up the question, are size, value, and momentum special? If we select good anomalies, can we get something now? Okay, that's a tricky question because they could be lucky, right? That's what makes it difficult. We're literally data snooping here, right? Like we're literally looking at the right tail of the distribution. So we need to adjust for that bias somehow to illustrate why that's important. What about idiovol, which is also a very well-known anomaly? And what about the distress anomaly or failure probability? Those are boxed in red. Those didn't perform after publication, net of costs. So we're going to look at whether selected strategies are profitable, or can we expect them to be profitable rather than were they profitable. And we need to adjust for selection, hindsight, data mining, p-hacking, whatever you'd like to call it. We'll use two adjustments. The first is really simple. We'll only use in-sample information to choose our anomalies. It's very simple. We'll use things that make sense, that you think would forecast our post-publication results and choose anomalies based off that. The other thing we'll do is an empirical Bayes adjustment. If you're familiar with kind of big data methods, this is one of those things. Okay, so the first simple exercise is we sort, instead of sorting stocks, we sort anomalies on in-sample turnover at the anomaly level or the in-sample net return. Intuitively, low turnover should predict good performance, and high net return should predict good performance. And then we examine the mean post-publication return within buckets of these sorts, anomaly sorts. And here are the results. The top row shows that if you sort on turnover and you buy low turnover anomalies, you could get about 20 basis points per month post-publication. Net return shows relatively little predictability. You get 13 basis points, but that the standard errors are about 5 basis points. So there's not a lot here. And keep in mind that this excludes shorting costs, this excludes price impact, and shorting costs, according to a couple papers, average around 10 to 20 basis points. Okay, now that's a very simple thing to do. Perhaps we're looking at selection bias as a really complicated issue. So we want to at least take another look at this. So the other way we look at this is use this empirical Bayes. And the empirical Bayes method is actually very, very simple. All you do is you say that the expected return mu is normally distributed. We normally never talk about something like that. We never think of the expected return as a random variable. But the empirical Bayes method, you think about expected return as something random that you might want to estimate. And then you estimate that distribution. Normal is just the simplest thing you can do. And then Bayes formula tells you how to do the bias adjustment. But Bayes formula tells you that you should shrink those large expected returns towards the grand average. And how much you should shrink depends on that formula down there. And critically, it depends on the dispersion of expected returns. What that means is if If there's no dispersion in expected returns, all the anomalies will have the same expected return, right? So you have to shrink everyone 100%. So if that sigma mu is 0, the shrinkage is 100%, everyone's the same. On the other hand, if there is actual dispersion, we may not need to do much shrinkage. So the question is, what is that sigma mu? We estimate that sigma mu and take a look at how much shrinkage we should be doing. And here are the results. Before I go into this table, I just want to remind you that our results, our baseline cost mitigation allows for equal weighting. We use equal weighting whenever it performs better, right? So the top row includes that. And using equal weighting, allowing for equal weighting, we get the exact same result as we got in the simple adjustment. You get about 20 basis points among your best performing anomalies. If you restrict the data to value weighting, then it says shrinkage is 100%. There's no dispersion in expected returns. Everyone's the same. So just to reiterate, the average investor, according to this analysis, should only expect tiny profits from even selected cost-mitigated anomaly strategies. Let me give you a little intuition for why this selection bias is so large and why this heterogeneity here is just elusive. So notice the distribution looks a lot like a normal distribution, right? Not only that, it's centered around 0. Okay, so that's the null of no predictability. That's very close to the null of no predictability. The number of t-stats in this chart that are larger than 2 in absolute value is 13%, or the rate anyway. If there's no predictability, it would be 5%. They're not that different. That means that there's not that much dispersion in expected returns, or you could say that most of this heterogeneity can be explained by luck. Because I need to give a big caveat here that we are grouping book to market and size with a lot of anomalies that other people may not think are as good. In my relatively junior position in the profession, I am not in a position to say that we should group certain anomalies in certain groups. I attempted that and I decided that was a bad idea. So this is with a big caveat that we're grouping everyone together in a relatively naive manner. Okay, so just to wrap up, we studied the post-publication net returns of 120 anomalies. The post-publication net returns are tiny. They drop from those huge things that you see in the journals down to almost nothing. And the average investor should expect tiny profits, and even the best anomalies provide tiny net returns. Thank you.
So I'm one of these people whom Nadine referred to earlier today as another weird accent appearing on the stage here. I'm obviously not Australian, but I'm also a beneficiary of high quality education at the expense of the taxpayers, in my case in Belgium. I would like to thank the conference organizers, first of all, for the opportunity to comment on a topic that is near and dear to my heart, which is really thinking about how to implement academic research. And I really wish this is something that I had been exposed to more before I started my career in the industry a couple of decades ago. So shortly after I joined my first employer, asset management firm, I found myself in the midst of the debate, which was apparently going on for a while, between our buy-side stock picking analysts and our buy-side trading desk, where the buy-side analysts used dividend discount rate model to come up with ranks for stocks, quintiling. They kept great records of how their quintiles performed and claimed we should be outperforming benchmark by 6% per year. Now, if you listen to Andrew, I think you wouldn't be surprised to hear that reality didn't really live up to those expectations. And of course, according to the analysts, the buy-side trading desk was doing a lousy job implementing their great ideas. And the trading desk said, guys, what you come up with is absolutely not implementable. So from that perspective, with the benefit of hindsight, this is a great topic. I also think the choice of the papers here today is great because it really complements a lot of what was discussed with the earlier paper as well. Now, I also think if you kind of think about where we are in the industry these days, and especially right now when data to backtest anomalies and really the platforms to really crunch a lot of information, create portfolios is so easily accessible. I think it's great to take a little bit of a step back and really think about, what does it really mean to make this work. So to kind of summarize a little bit what this paper is all about, I would kind of say, like, this is all in the context jointly with the earlier paper, Are Anomalies Fact or Fiction? And so we have decades of empirical finance research which is suggesting there are anomalies, they are persistent, they do exist. But of course, over the last number of years in particular, a lot of people have been digging into the issues of, is this indeed just data mining? Is this all gone once it's published, it's in the public domain, it gets arbitraged away? Or is it so difficult to implement that after all, which is a little bit the conclusion, I think, from Andrew's paper, listen, there isn't really anything left to really take advantage of. But then you look around the room, you talk to people in the industry, and you see what type of products are really popular. You can get around a lot of people having successful products out there, risk premium, factory ETFs, quant equity investing, et cetera. And so the question is really like, how do you square these two things? And I'm hoping to maybe shed a little bit of light on this. Andrew's paper is really focused on not the topics of like the data mining, et cetera, but really thinking about this from an implementation perspective. And if you think about implementing anomalies, there are really two major components that they are trying to address, which is number one, implementation costs, and number two, portfolio construction. And of course, the two of them are incredibly intertwined. So first of all, if we think a little bit about implementation costs, the paper's back of the envelope calculation, and Andrew had it on his slides earlier on as well. What are net returns? Well, you take gross returns, you take into account how much you're turning over, and you have some notion of implementation costs. So back of the envelope here is 30 basis points per month gross return. I'm obviously turning over both sides, 15% of turnover per month, and the implementation costs, take or kind of like more or less 100 basis points, and this is for its post-publication period. So 30 minus 30, 0, we can all go home. My first reaction to this was, going back to my days as a Eugene Fama student at the University of Chicago. It's kind of nice, fits in with, the notion of there's some overall efficiency going on. So this gets arbitraged away, or, it's just not implementable. My second reaction, having worked in the industry, was, and I showed this to some of my colleagues in my former team, 100 basis points implementation costs, that's ridiculous. These people should be, firing their executing broker and go somewhere else. So kind of like digging a little bit into the numbers, I'm showing an example here of, kind of trying to square the information that Andrew and his co-author put together versus, what you see in practice. And we'll dig into this a little bit more. So first of all, I would like to congratulate Andrew and his co-author for doing a ton of work to really be pulling together his measure of costs going back so far over time. I will not go down the list of like here are all of the shortcomings. I think the notion of like simplicity and trying to put at least some sort of a handle around, is there some sort of a lower bound we can get around, is very admirable. They're also providing a social good here by putting all of the information out there for people to consume and play around with, and I think it's incredibly helpful if more people can get their head around what it really would take to implement. So Andrew ended up talking a lot about, like, hey, listen, what we're doing here is using effective spreads. And obviously, the authors are very well aware of the potential shortcomings. They list them in the paper. Andrew tried to preempt it as well. That doesn't mean that I'm not going to be talking about how to think about measuring trading costs anyway. But I do want to call them out for that. And also because he made a comment about this is potentially a lower bound. So on the left-hand side is the graph that he showed earlier, obviously going back all the way to the 1920s. What I put on the right-hand side is what we're more familiar with in the industry. Is going back to some comments earlier as well about universes like the S&P 500, the Russell 2000. Now, again, the space of transaction cost and transaction cost modeling, I've realized this as well, having been on the academic side and now being in the industry. It's a space where the academics are so handicapped because you really don't have access to the right data. Because if you really think about this, what you're trying to do when you're coming up with how expensive is it to implement my ideas, kind of take a look at the picture on the left here, right? Like you're running a backtesting strategy or you're balancing your portfolio. You know you need to make some changes to the portfolio. So you've made a decision. You hand over that decision to your buy-side trading desk. The buy-side trading desk then in turn is going to make some decisions about, am I just going to send this off as a market order, which is the assumption that's being made here in the paper? Am I going to spread this out over multiple brokers? Am I going to be using an algorithm? Then you can drill down and the whole space of execution analysis, I'm not going to bother to go through it because it's completely beyond the purpose here. But an algo then is going to make some decisions about how am I going to spread out the order over time. Then all of these tranches then in order are going to be handed over to smart order routers. They're going to make decisions about which particular venues to execute on, et cetera. And so it's a very complex system. At the very bottom there are these little squares that we put up. You got your little venue executions. And so they all combine up to making this ultimate portfolio decision translate into executions. And what Andrew is measuring is this very, very last piece here of individual executions. Obviously, again, because it's working with tag data, you can only work with what you have. And as I said, they've done an admirable job with that. But in order to really kind of grasp the whole notion from top to bottom, there are a bunch of other things that come into the equation. And that's the whole space of how do we model trading costs. And so what we end up doing on our side, where we do have the benefit of having actual parent orders, and even then that's a caveat because we only come in kind of the second, third layer there. A buy-side client may have already spread that order over multiple providers. But again, we're sitting higher up in the food chain. So we have a ton of data that we collect every single day of the week, where we can say, okay, now let's run an analysis around it and figure out what's really driving shortfall, which is kind of like what was the mid price at the time I made my trading decision, all the way down to an aggregated weighted average of all of these executions. And so we tend to model that. We're not the only ones. I mean, this is very standard in the industry. You look at this relative to indeed bid-ask spreads because they matter. Volatility, very important. Volume over an execution horizon, when exactly you're executing, because there's a big difference between executing at the beginning of the trading day, executing over multiple days, et cetera. And then obviously order size as well. And one of the biggest concerns that I have with the approach that has been taken is the issue here of order size is nowhere coming into the equation. It's going to matter quite a bit as well. And so it's a big driver. And to give you some sense around that, here is some analysis that you see. I mean, we obviously benchmark our models as well to see if they stack up to reality. And this is out of sample analysis. I'm going back a couple of years here, but kind of fits into the time frame that was used in the paper, where we look at the expected costs, the actual costs, which are the red lines, and then kind of a little bit of a statistical measure of error around it. And then we bucket this based on how big is the order, and typically you look at that as order size relative to the daily volume for a particular name. And so you can easily see as the size of an order increases quite a bit, you can just make the assumption, I'm going to do more sophisticated portfolio rebalancing, and I'm just going to assume that the trading costs are going to be independent of how much I'm trading. And then on the right-hand side, another way to look at this, this is kind of like current data for expected shortfall for S&P 500 names, kind of a distribution around that, assuming that you're trading tiny amounts that don't really matter, 0.1% of ADV, so that's the blue, light blue for the S&P 500. And then if you go up to 5% of average daily volume, that distribution, the red one, shifts quite a bit. And then you see this again for Russell 2000 names, more spread out, even for much lower percent of ADV. And then if you go up to 5% of ADV for those names, you have a ton of names that are going to be indeed in the ballpark of what Andrew was talking about with his back of the envelope of 100 basis points. I just want to give you guys a little bit of a notion for how those numbers stack up. So let's kind of now move into the second component, because they're really very interrelated. Portfolio construction. So Andrew and his co-authors spent some time in the paper in terms of can we think about implementing these ideas in a smarter way. Because indeed, the bulk of the anomaly research is assuming I'm just going to construct equally weighted long-short quintile portfolios across my entire universe. And obviously, that's going to raise the questions of, well, wait a second, what are the weights of really expensive to trade names? What is the turnover here? Can we potentially mitigate this? And so that's kind of like, can I affect the end terms of the equation of translating gross returns into net returns? So to kind of simplify and summarize a little bit what happened in the paper is, okay, we can mitigate the weighted average bid-ask spread across the names by using value weighting instead of equal weighting. And then in terms of affecting the turnover, I can really, be doing something smarter, and Andrew gave a very nice explanation of how that methodology works to do the buy-hold spread. Now, when I was reading the paper, again, coming at it from more of a practitioner's perspective, kind of begged the question for me, like, why don't you go all the way down instead of kind of doing a little bit of a, heuristic approach? Do take advantage of tools that are available right now. And just going back to Jason's comment earlier on, use an optimizer. And an optimizer, allows you to kind of take the whole thing into account in one go. And industry has moved quite a bit from that as well. I remember when I started, like again, a while ago, it was more like heuristic approach to portfolio construction. Let's make sure our alpha ideas go into the portfolio. We'll kind of look afterwards whether we can mitigate some of our sector exposures, country exposures, et cetera. Let's take a little bit of a look using some shortfall model to make sure that we stay within bands and that the risk isn't all that bad. You can do this all in one swoop right now. And so, the typical way of going about is you got your, current portfolio, you got your stock alphas based on, your anomaly research. You have a bunch of constraints that you explicitly put into an optimizer as well. You have a shortfall model that goes into the objective function too. You have your risk model, and that's going to spit out your optimal portfolio. It's going to give you your trading list that you need to trade, and on top of that, you may potentially be doing a lot of sophisticated analysis to then further optimize how exactly you're going to trade. And I think if you kind of keep that in mind, you can easily, square that with what the real-world evidence is. And I know Andrew explicitly mentioned the Frazzini paper, which I think is the most extensive one in the space of like really looking at this from a practitioner's perspective. But there are some other places that have, published their experience with implementing anomaly-based type of research as well. And I just mentioned one other one up here. Now, the thing here is that obviously, in order to be able to do that, you need to be a large asset manager who has a ton of data where you can do the analysis. You also need to be willing to share this with the outside world. And it's not, every single asset manager is going to be able to just look at their own trading cost data and really do a full accounting of what's happening. The other thing that I think people need to keep in mind here as well, and I think that's bridging the gap a little bit too, there are other constraints that come into the equation. So most of these papers who've looked at it from a practitioner's perspective are only focused on a couple of anomalies. So you got Andrew and his co-author, 120 anomalies. The research that's available from the practitioners is typically focused on the size biases and momentum and value and kind of like the most well-known factors. So there's potentially a lot of work to be done in between. The other thing that I think explains a lot of the discrepancies between these papers suggesting, hey, anomalies can really be turned into something that is profitable versus the research more from an academic perspective is this is all conditioned on stocks that these people are trading. And so this is going back to Patricia's point from earlier, where I think a lot of the anomaly research is potentially driven by names that were more on the smaller cap side. I think that already accounts for a lot of the gap between 100 basis points of implementation costs versus the 5 to 10 basis points that we may be more familiar with. And so again, we need to keep in mind here that's not the end of the story either. It's a very conditional universe as well. But it all makes for, I think, a number of suggestions for further research. So I think a couple of things that can be done, and especially because the authors do have all of the data. You're sitting on 120 anomalies. You've got a ton of empirical data you can play around with. I would really suggest think a little bit about investability considerations. Think about how much of the results here are driven by the micro and small cap names, which have a ton of issues with them from an implementation perspective. They tend to be the higher risk ones. They tend to be the ones with very unpredictable trading cost implementations. They tend to be the ones that are very hard to short as well. I also would be thinking about this from a shorting perspective. We always look at academic research from a long short perspective. It doesn't mean that you can be using these anomalies in the context of underweighting names as opposed to everything needs to be 100% long and 100% short. So again, ways to go about it. And then the other thing here, and I think the previous speaker ended up talking about it as well, capacity considerations, like how much can really be implemented. But again, in order to be able to get there, your trading cost measure needs to have some notion of order size because otherwise it's just going to wash out. And I think, again, great paper, really enjoyed reading it. I think if, some of these other potential avenues can be pursued, it's going to collectively lead us to additional insight into what is really driving it and which of those can we really turn into P&L. Thank you.
Okay. Ingrid, thank you so much. Andrew, why don't you come on up on the stage? And we now have, I think, 3 runners. Runners, feel free to come right into the group so we can make sure we hit everybody.
Thank you, Andrew, for a great paper. I have a very basic question. It seems what you've done is, in the spirit of Ball Brown, an event study where the event is publication of an anomaly, and you're comparing pre and post. My question is, especially today, there's often many years between the discovery of an anomaly and the working papers and SSRN and conferences and the ultimate publication. Could you comment on that?
Yeah. So if you saw in my slide where you look at the event time plot, you see that the net returns start to decline a couple of years before publication. There's a different lag in every paper. We haven't gone through the extra work to find out when this was posted on SSRN, but then that's also tricky because we don't know how widely read they are. So the publication date was just a simple benchmark. Also, we kind of want to, there's no way to pinpoint exactly where it is, but we want to try to remove the investor learning effects completely. And so publication date seems like a relatively late date to try to get at that.
2 questions. Your bar chart that you showed up at the beginning with all of the various anomalies stacked up seems to imply that you think that these factor premiums are constant over time, and clearly they're not. The other problem I have with this approach is that you seem to be thinking that everything happens over a 1-month horizon, And lots of these factor premia work better over much longer horizons. I mean, value, for example, works over about a 9 to 15 month horizon. Momentum maybe over sort of 6 to 9 months. So how do you deal with that?
Well, so I just want to first defend a little bit that we absolutely take the perspective that these expected returns are changing over time, right? That's kind of like the focus of the paper. But in terms of the time horizon that it takes, I think the main comment I can say to that is that our rebalancing frequency depends on the particular anomaly. So for like value, we have a longer rebalancing frequency compared to say momentum.
Okay, question in the front.
Can you elaborate how did you calculate your trade price when you enter position, exit position, and effective bid-offer spread? Let's say you had earning announced after 4 o'clock. Did you enter position when market opened? Did you do VWAP? Did you use opening price, closing price, or what price did you use to enter and exit?
What we did is very simple. We average, and there are issues with what we do. I just say that up front. But we average across all the spreads that we measure within a given month. So there is a bit of a disconnect there, and that's something that we meant to take a look at. The academic papers always use the closing price at the end of the month to the closing price at the end of the next month. That's like the practice. So what would make the most sense is to, I suppose, use spreads at the very end of the day. But then you get a lot of noise there, and of course the investors have some latitude in adjusting that they don't have to trade at the very end of the day at the end of the month. So we thought to remove the noise and to informally account for this, we just average.
So you didn't use microstructure trading over the day?
No, we do not do any kind of like study of that issue.
You know, as Ingrid said, most practitioners that I know use a much fuller model of optimization with an alpha model and then a T-cost model. And so the sophisticated models will just say there's no way we're going to trade 100 basis point wide spread stock. But you don't have that luxury. It'd be like hard to publish an academic paper subject to some arbitrarily defined optimization process. But in your approach, if you said, okay, your general portfolio construction is buy the most attractive quintile and short the least attractive quintile, right? And then you did some things like look at different types of turnover. But if you just said, every single day when I form those portfolios, that you had that one graph or the preponderance of stocks were 5 basis point spreads, and then there was some of them that were 100 or 200. If you just say, within my quintile sorts, I'm not going to trade any stocks that have a bid-offer spread more than X basis points, say 10 or 20. My guess is your anomalies would not deteriorate. In other words, those quintile portfolios can live with not having a subset of stocks. If indeed there's a bias in the anomaly that the only ones that are working are the high bid-offer spreads, then that's something. But I think a lot of the more popular anomalies would survive if you just truncated those high bid-offer spread stocks.
Is there a chance I could get a microphone to my co-author by the TV back there? Because as I mentioned, we only look at two techniques to mitigate costs because in the academic literature, at least, those are the ones that work the best. My co-author Mihail is the one who knows the most about that.
Yeah, so we're prepared for a question like that. Hi, everyone. So I have a couple of papers, as Andrew mentioned, and in one of them we just compared, essentially looking at the universe of stocks with below median trading costs a year ago, and compared that to the banding or buy-hold spreads for the full universe using value weights. The appendix of our RFS paper kind of showed that the banding works better. And then we had a follow-up financial analyst journal paper. That's why we went with this. We can certainly examine it. For the RFS paper, we only had about 23 anomalies. Here we have a lot more, so maybe things changed, but kind of this was why we based this decision.
But I think a little bit expanding on that, it would be incredibly interesting to have more of an apples-to-apples universe. If you kind of look at, maybe 4,000 stocks or something, go back through time, kick out anything that were, the micro-cap names that these days may be private equity companies or whatever, were, maybe part of the gross returns being much higher is because a lot of those names were involved. Part of the execution costs being much higher is because it's exactly the same names. And it would be interesting whether that, leads to more gradual returns as opposed to everyone also saying, well, the reason why the returns have been dropping so much is only because of post-publication. It may be also because we're not really working with a comparable universe.
Oh, so to repeat the question, it was that suppose that we have a strong buy signal for a stock with a 200 basis point spread, but that's a temporary liquidity problem, and when the spread declines, then you should buy and you can avoid these costs. So comment to that is that that's probably not random, right? Like when the spread declines, the price will probably go up. You may have missed out on something. So in general, we find that other people find that anomalies are stronger in the hard-to-trade stocks, which is intuitive and which is alluded to before, which is also shown by paper I think it was presented here like a couple of years ago, that if you look before the 1960s, when you don't have a lot of tiny stocks, you don't really get much anomalies. It makes sense that you're not going to get even the gross returns unless you look at some microcaps. And if I could just comment on the 100 basis point spread that we're measuring, I understand that it's not what people in this room might see very often, but someone has to pay that cost, right? Like someone in every trade, there's going to be someone who's going to be effectively supplying liquidity to someone demanding liquidity. So we are measuring someone's cost.
One last question, just really quickly. Other papers that have been presented at our conferences, including those by Cam Harvey and others, have dealt with the multiple comparison problems. And we've known for many years that the distribution under the null is no longer T, and there's a non-centrality and a bunch of issues. So, and we've moved beyond Bonferroni corrections. Did you think about conditioning from Chen and Zimmerman, those 120, on the order of multiple comparison corrections? So, Cam Strong, T statistics above 3. And then looking subsequently, which is another way of saying your alpha model is interacting with your T-cost model.
Well, so I have a bit of an idiosyncratic perspective on that, because I have a paper on Cam's paper which finds that Cam and his co-authors did not calculate standard errors on their T-stat hurdle of 3. If you calculate the standard error, you don't really have any identification. And that you cannot determine that these where you should cut things off to control the false discovery rate. Taking on that perspective, I think how we consider multiple testing in our framework is that the multiple testing effect should be eliminated post publication. I hope that addresses the question somewhat.
But I don't think your results ultimately incorporate it, right? Why not just do the multiple comparisons test in advance and assign a strength to the signal?
I see. So okay. So effectively, we do. So the multiple testing in the end is not that fancy. In the end, the strength of the signal will still be proportional to the T-stat. Right, so when we do those, when we're doing that selecting the best anomalies exercise and we sort on in-sample net return, if we instead sort on T-stat, we would get at what you're looking for.
Right.
I believe the results would be pretty similar.
Okay. All right.
But we should do that.
All right, you got it. Andrew and Ingrid, thank you so much for a presentation discussion. You really did an excellent job.